Hello, everyone. Welcome to this new episode of the PwC Tax Bite podcast. My name is Pieter Deré, Global Tax Director in PwC Brussels, and I welcome you to this new edition. Today, in my virtual recording studio, I have with me three experts in European policy, and that's good because we're going to talk about the roadmap for business taxation in the 21st century, which was published today, 18th of May, by the European Commission. With me in the studio, we have Isabel Verlinden, the Corporate Tax Strategy Leader for PwC, Stefaan de Baets, former OECD, now Senior Counsel, holding, I must say, a very close finger on the international policy developments, and Jean-Philippe van West, an expert in European tax law, who is also extremely closely monitoring all these ongoing developments. Isabel, we're so happy that you could make it to this recording of the podcast, and the fact that you are here must mean that what we're going to talk about is a very important development. Is that right, Isabel?
Thank you, Pieter, and hi, everybody, and thanks for tuning in massively for this podcast. I was intrigued by it, Pieter, because I saw BEFIT, and I thought, BEFIT for people working from home since the last 14 months. Is this now about the European Commission trying to get us into a sort of a fitness subscription? But it stands for Business in Europe Framework for International Taxation. So it's definitely something that is going to trigger a lot of attention, not only in international press, but definitely is going to impact the strategy and the tax strategy of companies going forward. So that's the reason for me chipping in. And I also saw, Pieter, that a number of initiatives are already planned to chip in the fourth quarter of this year, 21, others for 2022. So there seems to be a sense of urgency in all that. And I would like to ask a few questions to Stefaan and to Jean-Philippe and to you as well, Pieter. The first one on transparency. I see quite some stuff on transparency here. Mandatory publication of effective tax rates. Stefaan, can you elaborate a bit more on that, please?
Yeah, thank you, Isabel. And indeed, transparency is one of the key topics or keywords within the vocabulary of the European Union. What they intend to do is to come up with a new legislative proposal for a new publication, new public reporting, actually, by large economic actors, by large economic enterprises, of an effective tax rate. The calculation of this effective tax rate would be based on accounting records, so not tax records, but accounting records, a bit like the Pillar 2 methodologies that are being developed. And that would then be the new transparency that needs to be reported. The point is, of course, that because they will calculate the ETR on the basis of accounting records and not on tax records, that of course there can be a deviation actually in the way that the figures are presented or the outcomes that may be the result of this new transparency measure to be tabled by 2022.
Thank you, Stefaan. From transparency to economic substance, maybe, Pieter. So I see some wording about companies with weaker substance. Let's call it shell companies or cash box companies. It looks as if the Commission has some plans to curb the use of those companies in particular circumstances as well. Can you give us a bit more detail, please?
Yeah, absolutely, Isabel. And it's not new that the European Commission is concerned about the potential abusive use of shell companies. But in the proposal today, there is a very specific announcement for a legislative proposal, and that would already come in the fourth quarter of 21, so quite soon. Shell companies, or what is the proposal about? Shell companies, companies with no or minimum substance, or very limited or no real economic activities. And these shell companies are often used to obtain certain tax benefits, abusive tax benefits by taxpayers. And the Commission wants to curb this use of shell companies by introducing specific rules that would require companies to provide sufficient information to the authorities so that the authorities can verify whether the use of certain companies in the structure are legitimate or potentially abusive and a shell company. And in that case, they could take the necessary action to terminate the tax benefits related to that. So that would be the proposal, Isabel, we expect, and that would come somewhere Q4 21, according to the plan.
And that's an interesting one, isn't it, gentlemen? Because I thought that with the BEPS project of the OECD, the focus was on the qualitative assessment. Do I have the people who have the expertise and the empowerment to credibly oversee entrepreneurial risk? Now it seems as if the European Commission is taking a bit of a step back and gives another tweak to this sort of analysis. So, Jean-Philippe, I'm sure you have digested things with particular interest when looking at things like losses, very relevant in this pandemic situation, or at least when talking about recovery from it, and also on, let's say, coherence. I read some stuff around debt versus equity. I'm sure you have a lot to say about that.
Yes, indeed. And there's, of course, something to say about that in the proposal or in the document. And first, regarding losses, the treatment of losses has been a point of controversy for a long time in Europe already. And now the European Commission comes up with a recommendation regarding the treatment of losses, because, of course, because of the pandemic, lots of companies have significant losses. What is important to mention here that it is a recommendation and not a legislative instrument, so not a directive. And of course, it has to be seen whether member states will follow this non-binding recommendation. A second point regarding stimulating or creating an investment-friendly business climate is dealing with the debt equity bias. And as you know, if you finance investment through debt, then you have a deductible interest. However, if you finance through equity, well, your dividends are not tax deductible. The Commission wants to address this bias, and as well is seeking to come up with a proposal beginning of 2022 that allows that provides for an allowance for equity financing. This is not new. We know this already in Belgium with the notional interest deduction, and we already have seen this as well in the CCCTB proposal. Maybe what important here is as well might be that because that the policy behind it, that might be that companies that have more equity and more equity financed, that they have stronger resistance against a crisis because they have more equity.
Thank you, Jean-Philippe. Stefaan, I see that this plan sets out the direction of travel of the EU, and that's probably where the acronym BEFIT comes from. Particularly under that chapter, I see CCCTB, Common Consolidated Corporate Tax Base. Can we speak of a revitalization? Can we speak of a resurrection? What's up on CCCTB?
Yeah, thanks, Isabel. BEFIT, tax-wise for the 21st century, that is perhaps how you could explain BEFIT, but BEFIT stands for Business in Europe Framework for Income Taxation, BEFIT. So they are getting good at acronyms, the European Commission. They say that CCCTB would be off the table. That is, that BEFIT would replace the CCCTB proposals that were handed out in 2011, 2016, so they're off the table now. But at least they're replaced with something else, the BEFIT. It's also a formulaic approach, and in the formula we see some, I would say, some common grounds with the CCCTB. We have sales at destination. We got labor, personnel and salaries as a factor in there, and also we see the asset factor again coming in. But it is not entirely the same, because sales by destination and the labor factor, that we recognize, but in the CCCTB, the assets excluded the intangibles, whereas the paper now indicates that the asset factor would include intangible, and I think that could indeed make a major difference, in particular with regards to the value chain of the enterprises, that indeed intangibles are now incorporated or could be incorporated into this formula. Otherwise, they explained, the European Commission explains it that well, because of you have 27 tax legislations that companies must abide to, so this will be a simplification, reducing red tape, the compliance cost. The same arguments that we have seen with the CCCTB are also here, I would say, reworded into this document. Also combating tax avoidance, growth, investments, also these elements come back forth, and they consider BEFIT again as a miracle for development within the European Union. So major issue is, of course, the inclusion of the intangibles now in the formula, and the proposal is to be tabled by 2023. So I would say that's the day after tomorrow.
So in other words, Stefaan, with the intangibles being included, we see that there is a factor of economic productivity being included, but it remains a formulary apportionment in a nutshell. That's what I understand, right?
That is absolutely correct. So the carve out of intangibles, or at least intangibles, is no longer there. It is now a carve in of intangibles, but indeed a formulaic approach is taking the same route as Pillar 1 and Pillar 2 under the OECD G20 project. All formulaic is all that we hear.
Okay, Pillar 1 and Pillar 2. I think there is a bit of a fatigue to talk about Pillar 1 and Pillar 2, but can we avoid it, Pieter? I don't think so. And being more into transfer pricing, I was always carrying more interest in Pillar 1, chopping off a part of the residual profit of companies and allocating that over the destination countries. Well, that seemed to me more interesting than Pillar 2. But Pillar 2 has become the sort of overarching theme, the theme of minimum taxation as a means to underscore the attempt for going in the direction of more fair taxation and so on. What is the plan saying about Pillar 2?
Yeah, well, the plan proposed today talks a lot about Pillar 1 and Pillar 2, but does not yet include a specific proposal. What the plan is rather doing is, of course, reiterating that because of the recent US changes and the proposal, that they are very hopeful to get a Pillar 2 agreement very soon. And basically the message is, if the global agreement on Pillar 2 is there, we will be ready to implement this in Europe. And how will that be implemented in Europe? Well, clearly via a directive. It's not a new debate that questions have been raised in different fora on compatibility of Pillar 2 and European law. And yeah, the Commission is clearly starting from the idea, with the directive, we can implement Pillar 2 in a way that it's consistent with European law and with many of the other initiatives in Europe. Because let's not forget that it's only a few years ago when, via the anti-tax avoidance, the ATAT directive, a CFC rule was introduced in Europe. The CFC rule looks a little bit like the income inclusion rule, which is the rule for introducing minimum taxation under Pillar 2. They look a bit the same, but they are very similar. And when Pillar 2 is being introduced in Europe, the necessary changes will need to be made to the ATAT, to CFC, to make this happen in a consistent manner. Other proposals in Europe that are impacted by the Pillar 2 is the debate around the interest and royalty directive. For a number of years already, there have been proposals circulating to introduce a subject to tax condition in the interest and royalty directive. So basically, only granting the withholding tax exemption for interest and royalties in Europe if the beneficiary is sufficiently taxed, is subject to effective taxation, or according to some proposals, even a minimum taxation. Well, that debate will of course be closed when a Pillar 2 is introduced, because then a general minimum taxation would be introduced in Europe. And furthermore, the Commission is also hinting that also the rules to determine third countries as non-cooperative jurisdictions, and there are many consequences of being qualified as non-cooperative in the eyes of Europe, well, that those conditions to qualify as non-cooperative would include also the Pillar 2 implementation. So if you don't implement Pillar 2, that would be one of the triggers to become to be seen as a non-cooperative jurisdiction. So you see, Isabel, it's not yet a proposal, but it's clear through the lines, I would say, that the draft proposal is ready, and that the Commission is saying here in the document today, we will be ready when the international community is ready with approving Pillar 2.
Thanks, Pieter. That's very interesting. So a change in the Anti-Tax Avoidance Directive, a change in the Interest Royalty Directive, and a new directive. So a lot to read in the coming weeks and months, undoubtedly. Stefaan, maybe a few words on Pillar 1.
Yeah, the document is relatively quiet on Pillar 1. That does not mean that they are not saying anything, but they simply will say, okay, we'll be ready for Pillar 1. The nexus rules and the allocation rules will be ready, and it will be implemented through a new directive as well. So that's actually what they're saying, fully aligned, I would say, with the Pillar 1 proposals that are currently being developed.
Thank you. Jean-Philippe, I would like to push the ball back in your court now and talk a bit about the chances of success of this plan, because I very well appreciate that this plan is not standing in the way of the ongoing work of the EU on digital levy, on public country-by-country reporting, on carbon border adjustment program, and so on. But can you give a bit more insights on what you expect to happen in the broader scheme of things?
Yes, of course. And a lot of the initiative mentioned, we heard the word new directive, change of a directive. We heard it quite often. And as we know, for adopting or amending an EU directive in the field of direct taxation, we need unanimity. Yeah? So there's unanimity required amongst all EU member states. So whether all these initiatives will be realized will depend pretty much on whether an unanimity can be reached. It's hard to predict, of course, the future, but if we look at the past, then we've seen that directives in the field of anti-abuse, such as the ATAD 1 and 2, and as well directives in the field of tax transparency, DAC 6, 7 as well recently, have been agreed upon, and unanimity has been found at a very relatively fast. So it can as well go really fast. However, we know as well some other initiatives, such as the CCCTB, have already been pending for several years. And it has to be seen whether now there is appetite amongst member states to reach agreement on this new BEFIT. So that's in a nutshell regarding feasibility.
Okay, thanks for that. I think, Pieter, we gave you in a nutshell what we think is going to happen. So back to you.
Yeah, thanks, Isabel. And you have been asking a lot of questions now, and now I will ask you a question, because I imagine that our audience here, when they see all these changes coming towards them, as a tax professional, you would be a little bit uncertain probably, and wonder, what can I do to cope with this? Is there any light you can shed from your experience in Europe, in the world, with taxation for all these years? What would should companies be doing to prepare for all of this, Isabel?
Oh my gosh, Pieter, I thought by asking questions I could avoid the daunting task of trying to answer them. But let me give a few sound bites on this. Effective tax rates. I heard Stefaan talking about the need to publish your effective tax rate. Effective tax rates need to be sustainable, predictable, and explainable. And this is all about making sure that you can defend the system profit allocation throughout your value chain. So your value chain analysis is more important than ever. Have your story right on that. So master file is just one means to do that, but there are many more. So take a deep dive into that. The OECD transfer pricing guidelines reflect that, as we know, since 2017. But this is really a call for action to take the bull by the horns and be very, very clear about your value chain analysis. And the other one is the health check of your existing current system, because I do appreciate the need for having directives, but we should not forget that while getting 27 countries on board, well, you need directives for that. But in other parts of the world, think about the United States, think about Asia, you don't have that sort of rigid framework that need to have that sort of directive. So this makes it even more important to do that health check from a legalistic perspective on your international tax structure. With these two suggestions, Pieter, I would like to pass the baton back to you.
Thanks, Isabel, and yeah, I really appreciate your input here. With that, we come to the end of this podcast, which I think was very interesting, with new words like BEFIT, a lot of anti-avoidance, transparency. So it sure will be interesting weeks and months to come in the European tax landscape. And if you want to stay tuned with the latest developments, I invite you to subscribe to this podcast series. That can be done via Apple, Google, or Spotify, or the PwC website. I end with thanking Stefaan, Jean-Philippe, and Isabel for being here, and I hope to see the audience again in the next podcast. Thank you.